Good afternoon. Welcome to Northeastern University's virtual economic policy forum. I'm Robert Triest, the chair of the economics department, and I'm delighted to introduce our guest speaker for this afternoon's session, is Mary C. Daly, President and CEO of the Federal Reserve Bank of San Francisco. President Daly began her career with San Francisco Fed in 1996 as an economist, specializing in labor market dynamics and economic inequality. She then became the bank's executive vice president and director of research. And starting in October 2018, she has been president and CEO of the San Francisco Fed. So President Daly, we're just delighted that you're able to join us on this afternoon.
It's my distinct pleasure. I'm very excited to be here. It's such an important time in our nation when you think about it. We're just starting to come out of the pandemic. Hopefully we'll get there soon, and our country will have to rebuild and recover from all that's been lost during this time. So I'm personally delighted to be sitting here with you, having a fireside chat and visiting Northeastern, even if virtually.
Well, we hope that someday you'll be able to visit us in person. Although one nice thing about the pandemic is that it's easier to have visitors from across the country come to a policy forum. Absolutely. So one of the things we'd love to talk about is the Fed's new monetary policy framework. So that's something that emphasizes that in the absence of inflationary pressure, the Fed will not move preemptively to slow employment growth. Could you tell us a little bit about how the new policy framework differs from the previous framework?
Sure. It's one of my favorite topics to talk about, actually. So we undertook the framework review to study the trends that are really affecting our economy, not just today, but are expected to affect us going forward. And several salient facts emerge, and that those facts are that we are going to be in a low interest rate environment across the globe, that inflation is going to be having a lot of structural downward pressures pushing it down, so that central banks everywhere are going to be fighting inflation to get up to our target as opposed to pulling it back to get down to our target. And that we also learned in the last expansion, and I would say often also in the 1990s, that we are not very sure where the level of full employment is in the economy. The economy is much more elastic or flexible than we thought, and people in particular are very flexible and dynamic and can come into the labor force and the labor market as conditions improve. So the new framework reflects those facts and says that we are going to look to reduce employment shortfalls. We're not going to worry at all about employment getting too high or unemployment getting too low. We're just going to work to reduce shortfalls. And we're going to turn our attention to really ensuring that inflation achieves our 2% average inflation target. So we're going to look at an average inflation target. So there's going to be so many times when we miss on inflation, we're going to make sure that we get a little bit above 2% on a sustained basis. So that on average, over a business cycle, for instance, you can see inflation hitting 2%. And those are the things that are different about our framework. We, of course, will continue to look at issues of financial stability and other risks to the economy, but the risks to policy are really one-sided. We can always bring inflation down. Our tools are fully available to us, but we have a harder time getting the economy back up because we're constrained by the zero lower bound. We have to use alternative monetary policy measures or tools to get to bolster that. So the framework reflects all of that, and it is a very different framework. And as you said in your opening question, we won't be preemptively taking the punch bowl away from the economy, taking the accommodation away in an effort to, not let unemployment get too low and not let inflation get to 2%.
Okay, thanks a lot. And I'm also an economist and Fed veteran, as you know.
Of course.
It's striking to me that this is a big change for the Fed. It's something I'm not sure if the public fully appreciates quite what a change it is. So in terms of the coming months, what do you think the new policy framework will mean in terms of how the policy evolves in response to labor market slack associated with the pandemic?
Sure. I think what you're going to see, and it is a big change. I got a little distracted on your question even because I was thinking about no, it's okay. The enormity of the change we've made. Some people have, from outside of the Fed, think of us as trying to turn a big tanker ship, that it's pretty much going where it heads and it only turns slowly. And what I'm really proud of as a Federal Reserve employee and a policymaker is that we have been nimble and agile, and we've really looked at the data and said, if we're going to do our job well, if we're going to make optimal policy for the American people, what are we going to need to bring to bear? And the framework really reflects that. So we released our framework in August of last year, and then shortly after that, in September, released our first piece of policy guidance in the FOMC statement that talked about how we're going to operationalize this framework in the unwanted test, but still a test of the global pandemic. And your question about the labor market, what we're going to, you see in that statement, the FOMC statement, is you see really 3 conditions that we will need to see in order to entertain lifting off from the zero lower bound and raising interest rates and starting to normalize policy. And those 3 conditions are full employment, not maybe it'll get there someday, but actually achieving it. So across a wide range of labor market conditions, we see full employment, and then inflation achieving 2%. And then the third condition being projected to overshoot 2% for some period of time. So as we start to see the economy recover and the unemployment rate fall, which is what most forecasters are projecting, and I'm one of those, then we want to discipline ourselves, really be strong here and not get overly joyous that the unemployment rate's coming down when so many other measures of labor market activity remain well below their pre-pandemic levels. They remain, still needing to recover. So what you're going to see in our framework is a good, healthy, and I think an appropriate dose of patience, looking through the decline in the unemployment rate and looking across a broad range of measures, and then looking through temporary spikes in inflation, which are transitory and will move away, and really looking for that sustained achievement of 2% and that sustained projection of overshooting 2%.
Okay, thanks. And again, that's a big change from the way the Fed used to do things, certainly during much of my career at the Fed. So I stated that very well. So what do you think the new policy framework will result in a faster return to favorable labor market conditions than would have occurred under the old framework?
I do. And this really comes down to expectations. So monetary policy, part of the power of monetary policy is it informs people's expectations. That's why Fed communication is so critical, because you want people to form expectations and make plans in terms of what they're investing in. Are they buying homes? How are they going to think about their business expansion? All of those things are informed by what you think interest rates will be going down the road. So what we've told households and businesses, market participants, is that you can expect interest rates to be lower for longer in this new policy framework as we wait to achieve these goals, as opposed to reacting to the forecast that we've achieved those goals. And that will mean that if you're an investor or a business owner or an individual, you're counting on those interest rates remaining low for a longer period of time, and you have really clear ideas of what the conditions will be when interest rates will start to go up. This helps us because it allows people to know that we really mean what we say. We're going to deliver on full employment, and we're going to deliver on average 2% inflation. That has been long serving us as credibility of the Fed, and I think the framework just bolsters that and is a powerful tool in and of itself.
Okay, thanks. So I'm going to pivot a little bit in the questions now. I think, as you know, the overall theme of our economic policy forum this year is on economic policy, inequality, and economic justice. And that's something I think people don't always associate with, the Federal Reserve, but I suspect we agree that it is something that's central to the Fed. So do you think that the new policy framework will affect historically less advantaged groups, including people of color, in a way that's somewhat different from the old framework?
Yeah, let me talk about that by going back to our framework review. So in our framework review, where we were really listening to not only academics and other policymakers from other central banks, but also to businesses, community leaders, households in what we called our Fed Listens events. And we went across the country to every reserve bank in every district, and we held events where we had community leaders and business leaders come in and talk to us about, what does full employment mean to you? What does running a strong economy mean to you? What does inflation mean to you? And we learned a lot from there. And one of the key things we learned, which I did some research on that was confirming that, but you really can see it in the communities, is that when we run a strong, sustained, underlying sustained expansion, disadvantaged groups benefit. The labor market gets tighter. Employers take a second look at individuals they might not have thought about before as possible employees. They get hired, they become very productive workers, and they gain ground in terms of their own economic mobility. So a strong, healthy, sustained expansion benefits everyone, and especially benefits people in those less advantaged groups, whether that's communities of color, historically less advantaged groups, communities of color, women, people with less lower educational attainment or fewer skills, people who are just re-entering after long periods of absence. All of these people get a second look from employers. And when they get a second look, they're very productive, very engaged, and want to participate. And so that's really, in my mind, the magical force of a long and sustained expansion. And that's what you can deliver in the new framework. And by saying that we're not going to be preemptively, I said this earlier, we're not going to take this punch bowl away. That's what we used to say in the 70s and 80s. The Fed always takes the punch bowl away just when the party's getting started. That was sort of a way that people described us as policymakers. That's something that worked maybe in the past, definitely doesn't work now. And we're committed to leaving that punch bowl or that monetary policy accommodation in place until the job is fully and truly done.
And I guess in the 1990s, and then again in the period leading up to the pandemic, we really saw the power of a tight labor market in helping people who are otherwise disadvantaged.
Well, I did some research that's available. It's a Brookings paper, and with some co-authors, also some Fed colleagues. And what we've documented is that these historically just impervious to anything gaps between, let's say, Blacks and whites or Latinx and whites, these gaps in wages, employment, labor force participation, income, they actually narrow when the economy has a sustained expansion, and especially when we do what we call run a hot economy. Now, I'm always cautious to use the word hot economy. I used to use it all the time. I'm a labor economist by training. And then one of my community advisors said to me, I don't know what you mean by a hot economy. In my community, we're always in recession. And so it gave me a sense of, not everyone experiences this hot economy. And so we have to be cautious about how we think about that or use it. But here's what it means from a definitional perspective. When the unemployment rate, the one that we measure, the aggregate one, falls below what people estimate is the natural rate of unemployment in the economy, that's what traditionally economists, macro and micro economists, would call a hot economy. When that happens, when our estimates of this natural rate are one thing and the measured unemployment rate falls below that, disadvantaged groups, and really if you're a person interested in inequity, this is really important, disadvantaged groups benefit even more than advantaged groups when that happens. So that means letting the economy run beyond what we think from our models is the right level of unemployment to hit full employment is particularly beneficial to less advantaged groups. That was a really important lesson from the 90s and from the last expansion, and one that I now see codified into the framework that we've undertaken.
So I fully agree from the evidence I've seen, including your paper. And so that, it's hard to overstate the importance of that, I think. So why do you think it's important that the Federal Reserve take, the concerns about equity into account in its policymaking?
Well, if you think about what our job is, Congress gave us a dual mandate, full employment and price stability. And full employment means two things in my mind. Full employment means how many people can get to work today so that every American who wants a job today can get one. And that's going to be some number of people. But that we also build for an economy that will serve us tomorrow. So every year, the number of people who would be qualified as full employed should grow and grow and grow. We should be thinking about dealing with the economy we have and building for the economy we want. And in those roles, the Federal Reserve has two important in those goals, the Federal Reserve has two important roles. One is to allow ourselves to really see what full employment looks like, really let the person who's at the back of the queue have a chance to get a job. So that's one of our goals, in particularly important. Again, helps disadvantaged groups, but also being out there and talking about how valuable it is to reduce inequities broadly in our country. Educational equities, skill trainings equities, job allocation equities, who gets into what kinds of fields, credentialing inequities. Those are things that are going to be very, very important to our potential output growth down the road, how quickly we can expand. And ultimately, those things affect our global competitiveness, how wealthy we are as a nation as a whole, how big the pie is. So all of these things are important roles for the Federal Reserve to play. And ultimately, I think for too long, economic justice has been relegated into a social issue, but it really is an economics issue, and the Federal Reserve works on economics.
Yes, I know back when I was in school, we used to talk about the trade-off between equality and efficiency. But I think what you're saying is that there really isn't any trade-off in this case in terms of Federal Reserve policy, and that addressing problems of inequity really feeds into promoting economic growth and general prosperity. Is that something you'd agree with?
I would agree that, well, let me just say yes, and then let me go through how I say it, because I think we say it a little bit differently, but mean very similar things, is that, the textbook case that there's this trade-off between equity and efficiency, it somehow got in our minds as a truth, but it's always and was forever a testable hypothesis. And what we've seen as we test the hypothesis is it's actually not true. Again and again, we show that equitable systems are efficient systems and they grow more quickly, they're more productive systems. And I think bodies of research have shown that repeatedly. And all you have to do is go out in your communities and see that the level of interconnectedness that the pandemic exposed, we're always interconnected, but the pandemic exposed that we all depend on each other in these very critical ways. If you're a teleworker and you can't get groceries, you need your essential workers who are working in the grocery store, you're completely connected to each other. And learning that helps us understand that equitable treatment helps the entire community, helps the entire ecosystem. And that is ultimately going to be efficient, productive, and deliver the next generation a better future than the one we inherited.
Well, that's really well said. So some of the critics of the Federal Reserve have maintained that the new framework could actually exacerbate wealth inequalities through its effect on asset prices. So what's your response to that criticism?
Sure. And, I think it's fair for people to raise these questions, especially when the stock market has been going gangbusters, so to speak. And I thought it was so fair to ask the question and important to answer it that I wrote a speech on it last year that I get delivered. You can find it on the website, where I just asked the question, is the Fed contributing to inequality? And I detailed in that speech that there are so many things we have to consider to answer the question. One of them is, what kind of inequality are you talking about? Are you talking about wage inequality, employment inequality, income inequality, or wealth inequality? There's a lot of ways to measure it. And then also about how the economy works when we lower the interest rate. So let me just do very briefly a simple thing that I think is important to know. When we lower the interest rate and the economy is expanding and it's continuing to stay steady, even when we were providing accommodation prior to the pandemic and the economy is really growing, then what happens in the data is income inequality, wage inequality, consumption inequality, employment inequality, all the inequalities that are on these real side of things, these measurable variables, they all go down. The lower end of the distribution is getting closer to the upper end. In fact, wage growth for low wage workers was faster than any other group in the year before the pandemic. So that's a good thing. The other thing that happens is, because the economy is going robustly, people invest in assets, and asset inequality or wealth inequality goes up. Now, the problem there isn't the interest rate policy. The problem is that fewer people have access to assets than have access to jobs and income. And so the issue as a society we need to face is how do we get more people access to homes, home ownership, stock market participation, bond market participation, assets that can help them grow wealth, not just have them in the economy that delivers income. So ultimately, though, in this speech, I will conclude, yes, the Fed's policies do support lowering some parts of the inequality measurement and they're part of increasing wealth inequality, but not the whole story. These things have been around, this inequality pattern has been around for a long, long time. And most important thing is when I balance off these different things, my job as a policymaker is to deliver full employment and price stability. And I am dedicated to delivering jobs and income and wage growth to the millions of Americans depend on them, because ultimately you can't buy an asset if you don't have a job. And so that's the role that the Federal Reserve can play. And we need to rely on fiscal agents and other regulatory bodies to help with the other aspects of wealth.
I find that compelling personally. And as you say, there are other policy makers in Washington that can address either access to capital and asset markets or taxation of wealth and capital gains as well.
Absolutely.
Yep. So another thing that the critics of the new policy have brought out, and sorry to be dwelling on the critics here, but
okay,
but that's part of it. But
absolutely.
The critics worry that the Federal Reserve might let inflation get out of control. Why do you think that concern is misplaced in the current environment?
Sure. And if I may, I'd like to just go back and say, since we're in a university, one of the things that's really important as a policymaker, and I take very seriously, is you don't learn very much if you only talk to your believers. You have to talk to the critics, and you have to take the questions of the critics very seriously. So all the questions you're asking me, where you say critics of, I've given a tremendous amount of thought to. I've talked to many of the people who hold those points of view, and I think that's part of healthy dialogue. It helps me make better decisions as a policymaker. So let's tackle this inflation concern. So the inflation concern, in my mind, the way I think about it, let me start from my first principle. The models we use, the models of the economy, by definition, reflect the architecture of our past understanding. So think about that. We construct our models based on what we've known has happened in the past. And so if you average over a long period of history, you can go back 30, 40 years and you can remember, and many people do remember it. It's like a scar. They remember that inflation rose up at one point and got to really high levels, and we had to pull it back down, and it was extraordinarily painful for the economy and for households and businesses in the economy. So that's a painful memory, and it's a tug. It's a tug of that fear to come back, that we could go back to that place but if we look at the last 20 years, and importantly, the next 10 years and the projections of what those are going to be like, those are not the risks we face. The risks we face as an economy are ones where inflation gets too low and we really can't get it back up. That's what happened in the last expansion after a decade of really solid, strong growth, one of the greatest recoveries in our history, one of the greatest expansions in our history. We never got inflation up to 2% on a sustainable basis. That was a miss of our price stability goal. And it's because it's very difficult to get inflation back up. So the risk is there in part because we're constrained by the zero lower bound. And that zero lower bound means we can't reduce interest rates as much as we would like because we stop at zero. We don't have a negative interest rate policy in the United States. So I hear the concerns that people are worried about inflation getting ahead of us, but we have no evidence that that's been happening. And importantly, we have the tools. So we have tools to evaluate those risks, and we have the tools to fight that from occurring, because we can always raise interest rates, slow the economy. That works extremely well still. And so the risk assessment, basically, bottom line is, the risk assessment is support the economy, get inflation back up to our price stability targets, and be prepared to watch constantly, but don't react to fear. So the new framework is don't be preemptive on our forecast. And it also embedded in there, in my opinion, is don't react to the fears of things occurring. Let's look and see when they do occur. And so far, they haven't occurred.
Yes. Thanks for the answer. And it's interesting. So certainly for my generation, we remember the great inflation of the 70s and early 80s. but it strikes me, many of the people in our audience today are students, and in their lifetime, and actually even in their parents' kind of young adulthood, they never experienced that. And so concern about inflation is kind of like fighting the wars of the past.
Yeah, I like that. We're fighting we're fighting the wars of the past, and I think it's a deeply seated fear, right? Because it was so painful, and all of us carry the scars of whatever the painful memory we have of our upbringing, but we really have to lean against those and move forward and look to the economy we have. And again, it's not to be cavalier about inflation, but we have the tools to bring inflation down. But you only need to look at Japan, that's been struggling to get inflation up to target for 2 decades or more than 2 decades, and the European nations, which saw their inflation expectations, a critical thing to keep well anchored at 2%. They saw those drifting down materially prior to the pandemic, and those have been even more deflated, pulled down by the pandemic. So we're not in that position, and I credit some of the reason we're not to the framework that we put forth.
Yeah, and certainly the Fed has better understanding of inflation and better kind of understanding the importance of inflation expectations to prevent something like what happened in the late 70s from occurring again.
Absolutely. And a little fact, if people want to read, if you're a historian of economics, I guess if you're in your 20s, the 70s are history. So for me, they're not. But one of the things that was true then is that wages and prices were very directly linked through what was called the cost of living adjustments. And so many employers had these automatic cost of living adjustments embedded in. So if wages, if price inflation went up, 6-7%, wages automatically adjusted, which of course made firms raise their prices again. And you could get into what, if you look in your Google or your history book, it'll say a wage price spiral. Those just don't happen anymore, in part because we don't have those automatic cost of living adjustments. Our whole compensation system has changed since the 70s. And so I think that's another mitigating factor that for any of the folks in the audience who are students of economics and want to learn about that history, it's it's an interesting time period that we don't have anymore. It wouldn't even be in your memory banks.
So I'm going to switch our emphasis a little bit again. And one of the greatest risks to economic growth stability is climate change, certainly in the long run, but also increasingly in short run scenarios. How's the Federal Reserve responding to those risks?
Well, that's a great question. I really appreciate the question. So when you think about climate, I want to be very specific and distinguish climate change from climate risk. And while that seems like a semantic difference, it's actually a material difference. So the Federal Reserve we're not climate scientists, we're not, and we don't have the toolkit in the way we're set up or in our structure to fight climate change, but we absolutely are responsible for understanding climate risk, the risk to the economy that severe weather events pose or changing weather poses, and then how to mitigate those risks so that we can continue to deliver our public policy to the American people. So we have really 3 core responsibilities, and we're working on climate risk assessment in all 3 areas. So think of our responsibilities. It's the payment system. We're responsible for ensuring the payment system is safe and sound and stable. And an easy way to think about how this is relevant for climate is when there's a natural disaster or a severe weather event, cash is the number one way people make exchange, because debit cards and other things go down when the electricity goes down. You can't use those devices when cell towers are disrupted or our electricity is disrupted. So we have to study climate to ensure that we've got enough cash inventories and cash depots and ways that people can get access to these things so that they can make exchange and buy goods and services even in severe weather. So that's a really critical component of it. And it's basically a big inventory management problem that we have to solve, but we have to solve it through the lens of what is the climate risk going forward, whether it's severe winter weather in Texas, or if they turn around and have a major heat wave in Texas. Either way, we have to ensure we understand what's going on in Texas or anywhere. Wildfires in the West, heat and winter weather, hurricanes, what you name it, we have to know about it. On the financial system, we need to understand we are supervisors or regulators of banks, and banks lend money, and we have to understand, what kind of risks are they taking now that some of the assets that they're using as collateral against the loans they've given are subject to severe weather events like fires, wildfires. We've seen this a lot in the western states where my district is, the 9 western states, especially in California. These devastating wildfires that injure and kill many, many people. So they're terrible for a human loss of life, but they're also, they destroy large amounts of property. And people hold mortgages on those property. Banks hold mortgages, and we need to understand those risks so that the banks can be well capitalized and weather those storms. One of my banking contacts said that in the fires in Oregon last year, said that the assets that were damaged by the fire occupied 1% of his total portfolio and 100% of his time thinking about, because it's really a risk that banks need to think about. They're already there. The Federal Reserve needs to understand that with them and be partnering with them in terms of how to mitigate those risks. And then finally, of course, we have the economy and monetary policy. Climate risk is already changing the distribution of wealth and capital and even income in our society across the country. And because of that redistribution, we need to understand that. It also affects, the economic output and potential output. So these are all things that will eventually affect monetary policy, certainly affect these equity goals we talked about earlier. And as a public service organization, and one that's responsible for, again, full employment, price stability, and then payment and financial systems, we have to be involved in understanding that. If we're not, then we're not doing our job effectively. We have to be forward looking as an organization. And we are. We've been very involved in this, and I'll stop there and then let you ask me a follow-up if you want. But we've been very involved in this in San Francisco, hosting climate conferences. We've just we started a climate group with 4 economists and studying these issues. Our bank supervision team works actively on this. And you're seeing this throughout the system as well. The Board of Governors just hired somebody to think about micro-prudential. If you that's about thinking about the bank stress testing, et cetera, with climate in mind. So these are all issues that we're actively thinking about, as are central banks across the globe.
That makes a lot of sense. It's really good to hear. Certainly here at Northeastern, we're in Boston, a city that's built largely on landfill. So that's something that's a risk that's quite salient to us here.
Sure.
So following up a little bit, so you mentioned the issues of equity in relationship to some of the climate risks. So you think the problems of climate risk, climate change, environmental degradation are another area where policy has an important equity element?
Well, I've been thinking a lot about this because it's hard to explain, what policy, monetary policy, this very blunt tool can do. And so the very first thing I want to say is think of policy, Federal Reserve policy, as being broader than just monetary policy. It's regulatory policy for banks. It's the payment systems policy that decides where access to the payment system is located for cash, et cetera. And all of those things do have material impacts on the distribution of the equitable distribution of things in our country. So I'm thinking about this more broadly, though, in terms of what do we even study? So as a economist, you get taught very early on. You'll remember this. We get taught very early on that free trade is good. It's good for everyone. It materially increases a country's economic output to trade with other countries, comparative advantage, et cetera, et cetera. And so as an economist, you say this, and you have in your head this very important caveat that says, well, that's true as long as you redistribute some of the gains that the entire country makes to the losers who no longer have their particular job because it's now produced somewhere else in a different country. And we forgot that part a little bit as a profession and as a nation back when we globalized and opened up the trade. And a lot of cities were completely displaced. Workers never came back. The cities, the Rust Belt, has that name for a particular reason. Jobs left and nothing came back for them. And so you have to bear with me to get the analogy, but I learned from that. And what I learned is while we are as a nation, as a Federal Reserve, as fiscal agents studying climate risk, we have to be very, very careful to figure out who will be benefited and who will be harmed, and how we're going to help that transition be easier than it would be otherwise. It's not, for instance, just about we're all going to go green and anybody who wasn't in a green industry is going to have to fend for themselves. It's really that we have to think about it as a nation. What would the distribution of economic output look like? Not only because of severe weather events, but because whatever transitions we make to mitigate climate change, which are in a different area than the Federal Reserve, but we have to be very aware of that. So I think these are important questions. One of the things the Federal Reserve does is it studies issues in this nonpartisan way that helps policymakers who are not us make informed decisions. And so I'm thinking about those things as well. And ultimately, how fast our country grows, it is very important to the Federal Reserve, because we are trying to get the economy up to the sustainable level of output, and how high that level of output is what we have to target. But again, work with the economy you have today and build for the economy of tomorrow. And our output will be higher if we include everyone.
Okay, so I couldn't agree more with you on that. And I think you said it extremely well. And it's something that I think in my own teaching between my pre-Federal Reserve years and post-Federal Reserve years, I emphasize a lot more that not only follow the efficient policy with trade or other things, but also make sure that people are harmed by the policy are made whole. So that really is important.
It's important. And we're going to see that, if I may interject one thing, this will be a very important lesson to pull through when we begin to recover from the pandemic, because we've all really right up in front of us had this pretty large magnifying glass on our economy. And we've seen how inequitable it is, how many inequities are there. And it will be tempting. I guarantee it. It will be tempting to forget as soon as the economy starts to pick up steam and people go back to their lives. And we can't let ourselves. We have to go back and do, as you said, which is make the economy, make those who lost so much whole again, so that they can really do that, whether that's post-pandemic, in climate change, or in trade.
Okay, so thanks so much for this conversation. It's been really wonderful. And I think we have some time now to take questions from the webinar audience, if that's okay.
Terrific. I love questions.
And the first one, which actually was the first one somebody posted in the question and answer area, actually is kind of a nice follow-up to our discussion just now. And it's, okay, so what happens when there is disagreement on whether to raise or lower interest rates at one of the FOMC meetings? And specifically, what measures are being taken to address the regions or industries that might be negatively impacted by the decision, which follows up a little bit on our discussion of how policies can have disparate impacts on people.
Sure. So I'm going to break that question into two parts, and I'm going to start with the latter part, the second part of it, which is, what do we do when an interest rate decision we take actually has a different impact depending on what industry you're sitting in? And that's almost always going to be the case. I mean, we have a very blunt tool. So let's go back to, we have the federal funds rate. We move the interest rate up and down to stimulate or restrain economic growth. And that's a blunt tool for two goals: full employment and price stability. And it is going to be a fact that when we're treating that aggregate economy, the interest rate policy we take will be benefiting more, some industries more than others, and some regions more than others, just depending where they are on the curve, because we're doing it for the aggregate economy. Now, the lessons we learned from the framework review and are now embedded in the framework tell us that we have a lot more room to run than we thought we had in previous periods. And so we can get more people involved in the economy. We don't have to preemptively strike and restrain growth before those people are part of it. But that's still not going to mitigate all the challenges or remove all the challenges that some industries or geographies face. And this is where the really big underline of the following point comes. The Federal Reserve is one part of the overall approach to solving our country's difficulties and facing our challenges. Fiscal agents, those would be your members of Congress, your state and local leaders, they have to do part of this as well. In fact, we have a very narrow set of tools that set the table for economic growth, but the specific industry relief or trade policy relief or climate policy relief, those all have to come out of the fiscal agents, the elected officials. It's the way we say it in a very easy to remember space is we have lending powers, not spending powers. And you need spending powers to redistribute income in the society, to give support or transfer dollars to different groups. And so we have to work in cooperation. We don't collaborate, we're independent, but we have to work in cooperation. We have to all be swimming towards the same goals, and that is to best serve the American people. Now, on the first part of the question, he said, what happens? The question was, what happens when there's disagreement about interest rate policy? And I will say that there's almost always disagreement about, I mean, in some really clear moments, like a pandemic, you can get the answer is so clear that everybody sees it exactly the same way, but that's very rare. There's always disagreement. And that is actually what you want. You do not want central bank policymakers to come in all thinking exactly the same thing, especially when the world is so complicated and there's a lot of uncertainty, because then you would have no debate and you would be a body of basically introspect. And you don't want that. You want people to come in and to put different views forward and to debate them and discuss them, and then reach a consensus basically of what's the best thing to do for the American people today. And I have this mantra, some people have heard it before, many probably haven't, and I think it can apply to how the Federal Reserve does its policymaking. It's what I use. I see it in my colleagues, even if they wouldn't say it. You have to be, as a policymaker, just absolutely voraciously curious. Every day you have to get up and say, what don't I know? How can I learn it? Then you have to be confident the day you take the decision. And that's what we do. We go in there, we're very curious about what each other are saying. Then we make a decision about what we're going to do. And we're confident about that decision because we know it's based on everything we know today and our very best effort. And then as soon as we take the decision, we're humble that we need to learn more, that we may not have the full story, and you go back to being curious. And so if you have that cycle, that curious, confident, humble, and that's your mantra, you end up constantly asking yourself, what more do I need to learn to do my very best? And you don't shy away from disagreement, because disagreement is what allows you to feed that curiosity that you need to have the best policy. So I hope that answers your question. Bottom line is, disagreement is our friend, not our enemy. And without it, we would just have an echo chamber, and you don't want that from your policymakers.
I guess actually this because the audience members' question, but is that the Federal Reserve's federal structure and the structure of the FOMC really, helps to spark debate.
It does. That's exactly right.
So I'm going to take another question. Sorry, I thought I had it here, but so now I've lost it here. So one is switching gears, but do you see a place for cryptocurrency in the economy now or in the future? This is one, I think the young people, hear a lot about Bitcoin and a lot of enthusiasm about that.
So can I just take a moment to distinguish, let's just take Bitcoin, because everybody talks about Bitcoin. Let's take a moment to distinguish Bitcoin from a digital currency. So Bitcoin is an asset. A currency has completely different properties. A currency doesn't change its value depending on, there's no limit to it. So it moves in its dimensions as the economy grows. There's not a short supply, so the value of it goes up. It's literally flexible, fluid. It moves with the economy. It's just a medium of exchange. Bitcoin is an asset. There's a certain number of the Bitcoins that are mined. Their value fluctuates depending on how many people want them relative to the fixed supply. And so that has no properties of a currency and isn't really going to be used as a medium of exchange in any kind of global way, because it has this asset valuation issue and not a currency property. So the Bitcoins and those kinds of things are developing. They are, and we'll see how they go. But the more interesting part of this for me is that will we have a digital currency? And the Boston Fed and MIT are partnering on thinking about what would that look like, what would be the properties of convenience of that, and what would be some of the risks. So in anything we do that's an undertaking like this, and this is the part that I think is often missed, there's a risk reward kind of trade-off, right? On one side, you can have complete convenience, and on the other side, you can have complete limit on fraud, right? And so between fraud and convenience lies something that we would like to have, but we have to think hard about how do we limit fraud? How do we limit, trading for wrong reasons? We have all kinds of rules in place on our payment system now that don't allow things to be used for bad outcomes, that don't allow fraud to take place. And so all of these things have to be sorted out. But I think that right now, central banks across the globe are thinking of these issues hard. We're thinking about them ourselves. And so while I won't make a prediction, because that's a very dangerous game about predicting a time when this would happen, I will say that it's certainly on every central banker's mind that there are convenience pieces to this and equity pieces to this that are critical to our economy, and we need to think carefully about what would that look like in the future.
Okay, thanks. That's really, it is a very interesting area and very uncertain.
It's a fascinating area. If you're interested in working on any of those topics, I think the payment system is something. One of my best colleagues here is he's the head of the Federal Reserve's enterprise payments group that we just put together that manage all of these types of things, and he's been in payments his whole career, but it's becoming very like jazzy right now. It's like the new tech because it has these other elements to it. So if you're interested in just how people intermediate and pay each other and exchange, I think it's one of the hottest areas out there right now.
So I suspect you just sparked some career interest in the part of members of the audience. So thanks.
Very good.
So another question, actually going back to some of our discussion earlier, is how does the Fed look at the relationship between managing post-pandemic inequity and maintaining the targeted inflation rate? So this gets back very much to the discussion of the new framework.
Sure, and I think it's a very useful thing for me to reiterate this. So again, we have this very blunt tool, right? So our goals, and Congress gave us two goals: full employment, price stability. So those are the goals we focus on. And in focusing on those two goals, especially this full employment goal, what we have found is that the strong sustained expansion as we reach to attain 2% inflation and eliminate employment shortfalls, it delivers a narrowing of gaps between less and more advantaged groups. And so that's a positive outcome. And that is how we get to participate in the fight against inequity. But we don't do all of the lifting in that space because there are deep structural differences, embedded racism. If you look at the Racism in the Economy series that the Federal Reserve is hosting, this is, there were many discussions about how some of these things are so embedded in our system of education, in our system of skill building, in our system of employment. Those all have to be treated by other forms of our public service, including our fiscal agents and even state and local governments. And I would argue the private sector as well. We as a nation have to take a deep look at all of this and do those things. So I don't think of it as a trade-off between equity and inflation. What I think of it is we have two goals: full employment and inflation. What we found is we have an economy that has more room to run because we need to get inflation up to average 2%. And that gives us more time to experience what full employment really looks like. More and more people got in, gaps were narrowed, but that's only part of the battle. It's not sufficient. It's going to take everybody else doing their part as well for us to really accomplish the goal of having a more equitable society. And I just put a plug in for a paper I just finished with 2 research assistants. So if you're thinking about applying for a research assistant, if you're in your senior year and you're thinking about a Fed research assistantship, 2 research assistants and myself and someone else who's the head of our community development group, we wrote a paper and we estimated that inequities in our society, differences between men and women, blacks and whites, whites and Latinx individuals in employment, wages, whether they get the education, the same education, or even whether they get the same job given the same education, that those are costing us, have cost us since 1990, $71 trillion. And that's close to $3 trillion, $2.5–3 trillion a year of lost output, simply because we have a high tolerance for inequity. So eliminating that tolerance of inequity, equalizing our economy, would generate more income each year than we argued about in the CARES Act.
Wow, that's striking. And I think your research is really striking there in terms of quantitative magnitude, but it's very widely accepted among economists that discrimination, inequity, things that prevent the proper function of the economy, and are a constraint on growth.
Absolutely.
So that, and just the magnitude of that is mind-boggling and tragic.
Yes.
So another question is, do you see the change in the age composition of the population affecting Fed policy? Do you think Japan's age composition has affected its inflation efforts? And I'll add, wow, that's I'm not sure if I should have asked that now that I've asked it, but that's a hard question. I'm not sure if it's.
Well, I also think it's a really great question, because it gives me an opportunity to talk about R star. Okay, so I'm going to answer your question. But I'm going to have to do a teeny bit of little weedy things here, which I try not to do too much of, but it's kind of fun to geek out a bit. So the aging of the population and slower productivity growth globally. So the population is aging globally. Japan was on the first edge of that, but across the globe, population's aging. Even in less developed nations, the population's aging. So we have global population aging, and we have global slowdown in productivity growth. Those two things have slowed the global growth rate over time, and also lowered the neutral rate of interest in our society, in our economy, right? So the neutral rate of interest is lower. This is what you see if you looked at Fed documentation from 10 years ago. You'd say the neutral rate of interest is around 4%, and now it's 2.5%. That's 2% inflation and 0.5 real interest rate, or R star. So if you want to be really cool at a cocktail party, Google R star. You'll see that John Williams, one of my good buddies, and the president of the New York Fed, is a world expert on R star. And it's really just documenting that it's been on this slow downward decline. And some of that is because of this population aging. So your question is, has population aging made it harder for Japan to do what they need to do to get inflation up, in this way that they have less policy space, just like we have less policy space at the Federal Reserve? If I thought I could cut the interest rate 4 percentage points in a downturn, then I could really stimulate the economy. But we can only cut it, 2.5 percentage points in a downturn, about half the amount we typically would. And so then it takes longer to get the economy back on path than it would have if we were unconstrained by the zero lower bound. And that all has to go back to the slower growth rate, the lower neutral rate of interest. And it's definitely related to population aging, but also to the slower productivity growth that we have.
Thanks, and thanks for making geeking out seem very positive. People say that my experience is that when I talk about R star at a cocktail party, I find all of a sudden I'm in a much smaller group than I started in.
Well, it's true. You have to use your hands a lot. So my trick is I use my hands a lot, I smile a lot, and I make it sound like it's like the coolest thing. It's like Star Trek. Well, Star Trek's probably past the generation. Star Wars. If you make it sound like Star Wars, you're in good shape.
Okay, I will try that. It's a question relating to kind of current circumstances and also looking ahead. Looking at how hard COVID-19 hit the economy, are there steps the Fed can or already plans to take to better prepare the US economy for another pandemic like this one?
Well, I just hope that we will not end up in another pandemic anytime soon because of the devastating toll it's taken on people. I will say that you never know what kind of shock is going to hit you. Is it going to be a financial crisis? Is it going to be a pandemic? Is it going to be a dot-com bust? Will there be a oil price shock, a war? You don't know. So as a policymaker, what I tend to do is do your best to ensure that the economy is well prepared to take on any negative shock. And I will say that I feel really pleased about where the economy was prior to the pandemic. And here's what I want to point to. Several things were in place. So if you go back to pre-pandemic times, the economy was growing pretty robustly, solidly, but then growth had started to slow a little bit. There were these headwinds coming from Europe and other factors, trade wars, et cetera. And we cut interest rates 2 times against some pretty, loud criticism to make sure that the economy was really achieving its goals and that we were able to keep us shored up in the economy very strong. We came into the pandemic with a very strong economy. And if you look at how we've fared relative to other countries, we have done remarkably well in terms of maintaining levels of economic activity to the level that it's safe to do so. And I think that's partly because we were so well prepared coming in. We had a strong economy and people were very actively engaging in economic activity. We also had very well capitalized banks. So one of the things we learned from the financial crisis is banks need capital. And lots of rules and regulations were put on banks to ensure that they have high capital levels and that they keep those capital levels high so that they are well prepared to weather a shock. And banks were well prepared to weather the shock of the pandemic and continued to intermediate, lend money, helped with the PPP loan distribution. And this really, I think, was an important support for the economy going forward. So what did I learn from that? And what did I learn from our actions? And so then the pandemic hit and we knew that those 2 things were in place, which puts us in good footing. And then we added, there were 2 things that happened that I think we definitely want to learn from as a nation. One, the Fed took bold action. We didn't worry about proverbially keeping our powder dry or waiting to see how it really unfolded. We just took immediate and direct action when the pandemic began, cut the interest rate, opened facilities, got the treasury market dislocation resolved, really poured our efforts into bold action, and that helped. Things calmed down, people got the money they needed, et cetera. Congress matched the Federal Reserve's bold action. We did it, they were doing it at the same time. I wouldn't say they matched it as much as we both entities did it. Congress did the same thing, poured money into the relief effort, basically, we all built a bridge so that as many people could get through the pandemic as possible in good enough financial shape that they would be well prepared to restart activity when the pandemic was behind us. So in terms of a playbook, there's much more to learn. We'll definitely study everything that happened and learn more and pull some more lessons forward. But those are my top lessons right now. Make sure the economy is sustainable and strong so you're ready for any shock that comes. Ensure that we recover fast after the pandemic so we're prepared should another shock emerge. Make sure our banking system, financial system is well capitalized, and take bold action when bold action is required. Don't worry about it being too bold, because in these big emergencies, that's just not ever going to happen. You can't be too bold, but you can definitely be too timid.
Yeah, thanks. I personally found that very reassuring. I think the Fed and policymakers have learned some of the lessons from the financial crisis and the Great Recession, and that's the best way to prepare for any emergency, whether a pandemic or another shock that you couldn't even imagine right now. So that brings us very close to the end of the webinar. I want right now there are other questions. I apologize, members of the audience who contributed questions that we didn't get to. But Mary, President Daly, I want to thank you again so much for joining the policy forum this afternoon. I think it was really a great session and very much appreciate your being here.
It was my pleasure. I really enjoyed it. Great questions. And I'm sorry I couldn't see all of you in person. It's so fun to see a live audience, but thank you so much for having me virtually.
Okay, well, thank you. So this wraps up our policy forum session for today. The final, so we have a slide I think is being presented with our, that has the URL for the Economic Policy Forum here at Northeastern. So you can visit that website to see more information about the policy forum. And our last policy forum session, which will be on this slide, is on April 6th at 3 p.m., also a Zoom webinar. It'll be Professor David Otter of MIT, who will be talking on building better jobs in an age of machines. They'll be moderated by my colleague, Professor Bill Dickens. So again, thanks very much to President Daly and to everybody who attended the webinar. Have a good afternoon.